The Japanese government has officially initiated a massive investment program in the United States valued at $550 billion, a move widely viewed by global analysts as a significant concession to intense economic pressure from the Trump administration. While presented under the guise of bilateral trade cooperation, the details of the agreement suggest a lopsided arrangement where Japan provides the capital to fortify American strategic infrastructure in exchange for relief from punitive tariffs. The origins of this deal date back to July of last year, when Tokyo pledged the astronomical sum to avoid heavy surcharges on Japanese exports. After months of internal friction regarding project specifics and control, the deadlock was broken as the first phase of projects, totaling $36 billion, received formal authorization. Observers note that these initial investments are specifically designed to address critical vulnerabilities in the American economy rather than providing equitable returns for Japanese industry. Among the primary beneficiaries of this funding are energy and technology sectors in key American states. In Texas, Japanese capital will fund deepwater oil docks and liquefied natural gas terminals, infrastructure intended to cement the United States as a dominant global energy exporter. In Ohio, funds are being directed toward the construction of the largest gas-fired power plant in history, specifically tasked with powering artificial intelligence data centers. Furthermore, in Georgia, the investment targets the production of synthetic diamonds, a vital component in high-end semiconductor manufacturing. In each instance, Japan provides the financing and resources while the United States retains the strategic advantage and supply chain security. The catalyst for this sudden compliance is the explicit threat of the tariff baton. With Japan's automotive and high-tech sectors heavily reliant on the American market, the prospect of being shut out through aggressive trade barriers left Tokyo with little leverage. This economic coercion is compounded by Japan's deep-seated military and security dependence on Washington, rendering a defiant stance nearly impossible. This strategy serves a threefold purpose for the American administration. First, it directs foreign capital into swing states like Texas, Ohio, and Georgia, creating local jobs and fulfilling domestic political promises at no cost to the American taxpayer. Second, it forces allies to subsidize the American hegemonic supply chain in sectors where domestic private capital is hesitant to invest. Finally, it serves as a stern warning to other allies, such as the European Union, South Korea, and Canada, that market access is now contingent upon direct financial contributions to the American industrial base. Critics argue that this protection fee model of diplomacy creates a precarious future for Japan. By tethering its capital and industrial future so closely to American strategic goals, Japan risks hollowed-out domestic growth and a loss of technological autonomy. As other nations find success through more neutral and diversified trade partnerships, Japan's decision to prioritize short-term tariff relief over long-term economic independence remains a subject of intense international debate. This development signals a shift in the global order, where the America First doctrine increasingly treats long-standing alliances as transactional relationships.